The good news for Treasury boss Michael Clarke is that now, after 2 months of due diligence and 6 months in the company, he's free to get on with the business and run it the way he wants to. The due diligence by all reports confirmed his strategy and said that was fine. It's just that they couldn't get up to the price, which was $5.20 a share. So for now, Clarke has said that he's running ahead of schedule in his first 3 months of this financial year, and in October he has the next Penfolds release, which should be another bumper for the company. So in some respects it's all onwards and upwards, although you wouldn't think of that looking at the share price today. Treasury Chair Paul Rayner has some questions to ask himself, given that he's revealed today that over half his shareholders thought the $5.20 a share price indicated was too low. That tells you that they wouldn't support such a bid, which was the bottom line for Rayner in accepting KKR to go into the due diligence room. If half the shareholders think that the company board has got it wrong in terms of what price it should sell at, then you've got to ask yourself, how much confidence do they have in the chairman? One would suggest not very much. For KKR, this was another failed Australian bid. The private equity firm had bid $5.20 a share, but in the course of the due diligence had decided they would drop that, or that's the indication you get from the company. TPG had its own issues with some antitrust concerns in the US, given it's also a big owner of retail outlets in the country. And for KKR's perspective, it wanted to load it up on debt, which just made the $5.20 hurdle that much too hard. From here, it's back to the drawing board for both private equity concerns, but at least TPG can look back on a much more successful Australian campaign than its US rivals.